So welcome you all once again to the question solving stage of IAS 40, especially on transfer. So IAS was 40, investment property. So investment property. Good. Question solving, especially transfer. That's where we have to get it. I will illustrate one transfer question, how you should go by transfer, and then we will move on. Good. Now, we list the various types of transfer in the earlier video. So if you have not gone through it, kindly go through that one for this and you will be fine. So let's look at this. Let's assume that owner-occupied property, that's PP, was transferred toward investment property. That's from IAS 16 to where? IAS 40. This illustration will also qualify for a transfer between cost model to fair value model. Have you seen? Good. So that is it. In the most section, you can have these scenarios. If I transfer PP to investment property, what are the scenarios available? First scenario. Here, the property will be carried at cost model. Here too, they might carry it at what cost model. So cost to cost, no transfer. Cost to cost, in fact, it won't have any impact on the calculation. Just that the presentation will be different. The asset will be moved from PP to where? Investment property. Good. From cost to cost, the value will not change. The calculation of the depreciation will not change. Yes, because cost will depreciate the asset, yes, will depreciate the assets. Except for if they change the useful life of the asset. Good. Then you can also have from revaluation model to that of cost model. You can also have cost model to that of fair value model. You can also have revaluation model to what? Fair value model. These are the two possible situations. Good. Now let's take it again. You can transfer from PP to what? Investment property. Or investment property to PP. Yes, we look at the various type. But today we are going to consider this. When you transfer from PP to investment property. Likewise, you can also transfer from where? Investment property to what? PP. Now the issue is this. The one that I'll do for today will be this section. Here we are saying that your PP, before you transfer it to become investment property, what model were you using? You can use the cost model. Have you seen? So you can transfer from cost to cost. When you go to investment property, you're going to carry it as cost. So that one, in fact, I'll tell you that there's no transfer. It's a change of what? The recognition and measurement. So the presentation will change. The item will move from PP to, so the value will not have any impact on the value except to change the useful life. So here there's no big deal. Then revaluation to costs. It's not other difficult. But from cost model to fair value model, there are some accounting boundary. There's some points that we have to do some coordination or some calculation. So I'll pick question on this and then let's it to you. You can also move the asset or carry the asset under the PP using the revaluation model and then transfer it to your fair value model. So that is the transfer. You can also transfer from here to here. Now I'm going to single on this and then talk about it because that is the troublesome guy among them. So when you transfer from where cost to fair value model, what is the accounting treatment? Transfer from cost to fair value model, accounting treatment. So let's see. Let's see. Let's assume that this year, January, the item was PP. You bought it 10 years ago. Your office building, that's the head office. 10 years ago, you acquired office complex for head office, use that head office. But now you've gotten a new place for or to use as the head office. So we decided to transfer the existing PP or the existing building towards as investment property. So let's assume that the transfer was successful. June. We did a transfer on June. Then at the end of the year, December, how do you value the PP? So here we assume that you are going to use cost model, but the examiner will tell you. I'm just assuming because I'm picking from that difficult section. If you are going to use cost model, and then here you transfer to investment property, yes, I'm assuming you are going to use fair value model. So transfer from cost to fair value model. Now, the asset must be depreciated until the transfer. So that means this very year, let's assume the transfer was successful in 2019. Here's 2019. So it means that the asset must be depreciated over here, from here up to here, because the transfer was successful at this date. Good. So here depreciate the assets because we are still using the cost model. How do you get it? So that's the first thing. The asset must be depreciated until the transfer date. So depreciate the asset from here up to June. So 6 months depreciation must be charged. Good. Then over here, two things will happen. We have to get a fair value of the invested property if possible. We have to also get a carrying amount. Yes, we can get a carrying amount. These two, they must match. Any difference, we have to use IAS 16, revaluation model. Yes, that's what the standard is saying. You have to use a revaluation model to account for the revaluation gain or loss. Take note that fair value gain and the investment property have a different accounting treatment under the revaluation model. So, in short, if the fair value is more than the current amount, any gain or loss, we have to account for the gain or loss under what? Under revaluation model, IAS 16 revaluation model. Under IAS 16. So we have to use IAS 16 to account for any fair value gain or loss at the date of transfer. Use IAS 16. Good. To account for any revaluation gain or loss. Sometimes the fair value will be given to you at the end of the reporting period. Good. Now, right after the fair valuation gain or loss being accounted for under the revaluation model, then the building is now properly ushered into what? Investment property. So from here going, investment property start from here going, I will get it. And then if there's another fair value at the end of the reporting period, then now I use what we call IAS 40, fair value model. What does the fair value model state? The asset, don't depreciate it. So from here going, no depreciation. Because investment property valued under the fair value model or held under the fair value model, no depreciation. Then when you go to the end of the year, let them give you another fair value. So fair value it again, what do? Then compare the fair value that you had when you did the transfer and the fair value you had at the end of the year. Any gain or loss, this must be accounted for using what? IAS 40. And then any fair value gain, you add it to what? Other income. If it's a loss, add it to operating expenses. So in short, this is the transfer, and this is the most common one. So this is how you're going to account for. So in the question they will give it to you, just look at this issue. First, my depreciation must be from where they did the transfer. Good. That is it. Good. So first, your depreciation. Now, the issue is this. If the transfer was done maybe at the start or at the end of the year, that question should not be too challenging. Why? Because at the start of the year, if you made any transfer, then the investment property starts from here. So that year, no depreciation. Full year, no depreciation. If you perform the transfer at the end of the year to that year, full year depreciation, good. But if you do it mid-year like this, that is where 6 months, no depreciation, 6 months depreciation in that order. Good. So let's take notes of that. So let's pick our first question. And then after that, I'll give one again. Then I'll explain the disposal and investment property, the treatment between group parents and then the subsidiaries. Then you are done. So let's pick our first illustration and the investment property. Good. Now let's look at this question. It says QRS Limited acquired property on January 1st, 2006 at the cost of 400,000 cedis and immediately occupy it as what? Office premises as owner occupied. PP IAS 16. Good. Great. On acquisition, it was estimated to have a useful life of 50 years. Subsequent to its acquisition, the asset was measured at depreciated cost until October 2011, when management of QR decided to convert the building into an investment property, mainly for rentals. Good. Following this decision, the property was fair valued at what? 380,000 Ghana cedis. The company adopted fair value model for the subsequent measurement of its investment property. As at 31st December 2011, it was fair valued at 390,000 Ghana cedis. Required. Account for the treatment of this property in the 2011 financial statement of the company. full stop. So accounting treatment. Here we want the extracts, what goes to the P&L, what goes to the financial position, and then you adjourn. The rest are workings. Clearly show all the relevant workings. So here I can see that there was transfer from owner occupied to investment property. I can also sense from the question that they were using cost model and the owner occupied, but now they want to use what fair value model at the subsequent measurement of investment property. We are done. So, and it was also done in the mid-year, October 1st, 2011. So here, if I should go back to the question, then look for these items. So first, look for depreciation from here to here. So now here will be October. So look for depreciation from January to October for 2011. So here will be 2011. Get a current amount as at that date. Then fair value was given. It was 390, 380. Then compare it, no depreciation from here to here. Compare this to the fair value at the end. It was also given 390. Then you adjourn. So this is how we should go by the question when there's transfer. Good, when there's transfer. So now let's dust the board and then do justice to the question. So when they ask you to account for the above transaction in your books, all what you can do is to prepare the relevant extracts, the two most relevant extracts. That is the profit or loss and what? The financial position. So here, I'll start by saying, okay, so here, good. Sorry. I'll start by saying the name of the company. So QRS Limited, right? Good. Then I will underline this. Second, the extracts. So the P&L for 2011. So statement of profit or loss for 2011. Let me write it for. So statement of profit or loss. So for that year. Then I'll leave enough space and come and continue the game by saying still statement of financial position as at that date. Good. So statement of financial position as at that date. Good. So what will go in here? That is the accounting treatment that we are looking for. Alternatively, you can explain, do your workings, your calculation, and tell us where those calculations reflected in the books. That is the accounting treatment. So which account to be debited, which account to be credited, and then in the final account. Explain it to us. If you can do that, why not? So first is the depreciation. So let's go and see when the transfer took place so that we can calculate the depreciation. That means for 2006, in fact, I 2011, but it's supposed to be 2000 it's supposed to be 2011. Yeah. It's okay. It's 2006. Good. So 2011, we are paying for 2011. The asset was acquired in 2006. So it's possible. Good. So in 2011, the transfer was made when? October. That means from January to October 1st, how many months? So that we depreciate it equivalent. From January, so depreciation, that's the first one I'll calculate. But here, I have to calculate from where? January to October, how many months? Can tell us. 10 months, right? And like that. Yes, I can see 10, 1st October. But October is first, so indirectly is what? I like that. I like that. Indirectly to be? Okay, so indirectly it is 9 months. Because 1st October, October will not be what? Will not be parts. So we'll end at where? September. So January to September, 9 months depreciation. What is the cost of the asset? The cost of the asset is 400,000. Good. Divided by 50 years. That's the life of the asset. Like this. Times 9 out of 12. And that will give us, I like the tryouts. Great. And that will give us, that's 400,000 divided by 50 years. And then you pick 9 months out of it. Good. Great. So probably you get something like 6,000. So that's, so check where the transfer took place. If the transfer is right at the start of the year, then that's the good news. At the end of the year, another good news. But mid-year, check the months and pick equivalent depreciation. Good. Now let's continue the game. Now we have to calculate the revaluation gain or loss at the date of the transfer. And to get the revaluation gain or loss, let's draw the normal line here small. So in January, they did a transfer in October. So in October, we need two items. One, fair value. Two, carrying amount of the asset. So the same date, we need carrying amount and fair value. The fair value, you don't need to worry. They'll give it to you in a question. So the fair value has been given. Let's go and pick it from the question. Fair value at the date of the transfer. Let's see. Following this decision, the property was fair value at what? 380,000 Ghana cedis. So 380. So the fair value we know 380. Then what's the current amount? So that we can use IAS in the revaluation model. Even though the company is using what? Cost model. Here, we have to adopt the revaluation model to just account for the difference. How do you get the current amount after this date? Current amount is what? Nothing by the cost of the asset less what? The accumulated depreciation. Good. So the cost of the asset less accumulated depreciation. And then you are done. Good. Now let's see. Now let's go and calculate the carrying amount at the date of what? Transfer. That is the next game. So let's go to the other side. So carrying amount, then we compare to the fair value, then we have the profits or loss. So therefore, let's see. To get the carrying amount, let's bring the cost. So first workings Number one, carrying amount of the asset. So carrying amount. Let's see how best we can take the carrying amounts. We know that is equal to cost of the asset less what? Accumulated depreciation. The original cost of the asset is what? 400,000 as at 2000 and what? 1st January. Now let's calculate the accumulated depreciation as at the date of what? Transfer. So we have to calculate depreciation per year and multiply by the number of years. So now from 2006, January 1st up to October 1st, 2011, how many years? Try. How many years? So that we will calculate just 1 year. If you want to get 1 year depreciation, this section, what is in the bracket is what? Depreciation charge for a year. Go, depreciation charge for a year. So let's calculate the number of years so far. Good. So counting it, 2006 is 1, 7, 8, 9, 10. So 5 solid years. But 2011, only 9 months, right? Agreed. So 5 years, 9 months, we are done. And you already know that. Yeah. This, what is in the bracket alone, is the depreciation per year. And we have factored 9 months into consideration. Good. So now what we can do is this. The accumulated depreciation is going for 5 years and 9 months. Then the 9-month depreciation, if we calculated it to be 6,000. So it's just a matter of we getting what? 5 year depreciation, and we add this 6,000 to it. We are done. How we get it? Let me take it again. We need 5 years, 9-month depreciation. We've already calculated 9-month depreciation here, which is what? 6,000. So therefore, we just need 5 years and we add it to it. We are done. Why? Because if you want to convert 5 years, 9 months into years, please don't say that it's 5.9. Not at all. It's not 5.9. It is not 5.9. Good. So that is it. But if you want to convert, I'll do all of them. I'll do all the alternatives. So first, we can calculate the 5-year depreciation first. So let's calculate the 5-year depreciation. So the 5 years depreciation will be 400,000 divided by 5 years. So divided by 50 times 5 years. Good. Then that will give us, if 9 months is equal to 6,000, then 5 years will be, so let's work this together. So that will give us 46,000. That is for the 5 years. That will be the 400 divided by 50 times what? Times 5. Okay, that will give us 40,000. So here the depreciation will be what? 40,000. Now plus the 6,000. Let me shift this one to the other end so that we can get space to do our presentation. Let me shift this one here. So the cost is still 400,000. So this one will give us, let me put another one here, 40,000. Then depreciation charge for the year. Charge for the year. We had 6,000. In all, we get what? 46,000 as the accumulated depreciation. Good. Now let's get the carrying amount. Then I'll use several alternatives to get the carrying amount for you. You select one. Exams, you need to be fast. Yes. You need to be fast and get the items for us. So, therefore, the current amount will be, the current amount will be 400 less 46,000. So that will be 354,000. 354,000. That is the carrying amount. So 354,000 is the carrying amount. Now, to get accumulated depreciation, alternatively, we can just tell the examiner that this one times 5 whole number. So 5 whole number, 9 out of 12. Just that this, if the calculator is not yours, the answer will be wrong. Yes. So to get a total 46,000, all what I'll tell the examiner is this. I will calculate depreciation for a year, which is 400 divided by the 50 years, now times 5 whole years, 9 out of 12 months. So this one alone can also result at the following. Then you are done. Now, alternative or shortcut to get a carrying amount. So now, outstanding. So charge. So this one becomes the carrying amount. Alternative to get this carrying amount, 354,000. All what you have to do is this. The assets have 50 years. Wow, 50 years. And now they've used 5 years, 9 months. So left with how many years? Can tell us. Left with how many years? Yeah. The assets, they are going to use for 50 years. Now they've used 5 years, 9 months. So left with how many years? So how many years left? Who can tell us? I like that. 44 years, 9 months. 44 years, 3 months. Good. So it will be 44 years, 3 months. So therefore, this carrying amount is nothing by the carrying amount that you see is nothing by you picking the 44 years remaining. Good. So convert the 44. Now 3 months means a quarter. So dot 25. So to be 44 and 9 months means 3 quarters, and that would be 0.75. Good. So 44.25 all divided by 50 times the 400. This answer must be the same as 354,000. So that is it. How? If you want to get carrying amount of any asset, don't worry yourself. All what you have to do is get the remaining life of the assets divided by the entire life, multiply by the cost to give you the carrying amount. Shortcuts are dangerous. This one work better if there was no scrap value. This one work what better if there's no scrap value. This question is no scrap value, so it work better. If there's scrap value, go by a long approach. So we are done finding the carrying amount. Now let's proceed to the revaluation gain or loss. So here we'll let result revaluation gain at the date of transfer. So at the date of transfer, October, carrying amount of the assets C is 354. But the fair value as at that date too was what? 380. So is there any gain or loss? So that is it. Is there any gain or loss? And we say any gain or loss as at that date, you have to account for using what? Evaluation model IAS 16, even though they were using cost model. I like this clause. So what's the gain? So that gain must be accounted for using what? The revaluation model. So in revaluation, all gains are reported where? Yes, we did that one last Monday. All gains are reported in the OCI. So let's go to the OCI. You can see that there will be gain because fair value of 380 is more than the carrying amount. And the difference is what? Is the gain. Because I said that to get a revaluation gain or loss, relax, get two items. The fair value less the carrying amount. So now let's go and do it. And then to go to the OCI. So first, I'll leave some space and come and write OCI here. OCI. I'll write it in full. Other comprehensive income. Income there. So, and you write revaluation gain. I'll do the workings here. The gain will be fair value of 380,000 less carrying amount of 340,000. But we could have done the calculation there. Yes. So I bring the final answer in. In fact, let's go and do it. Writing in here small. I can't see it here. So let's go and do it. Good. So workings number 2, revaluation gain or loss. Workings number 2. So to get a revaluation gain or loss, let us relax. So we need two items. They are the fair value of the assets at the date of what? At the date of transfer or valuation. So fair value was 380,000. Current amount, we've calculated it to be 354. Put it in brackets. So therefore, gain of 26,000 Ghana cedis must be reported. So the gain is what? 26,000 cedis. Good. So therefore here, workings number 3, or workings number 2, a gain of 26,000 must be reported in the OCI. We are done. So now it means that right after the recognition of this gain, the building is now and properly ushered into the investment property. So now that the building has been properly or duly ushered into investment property, so now let's use investment property. So it means that from October, where the value is 380, December, we have to fair value it again. So let's go to the question. And the said is what? 390. That means there's another what? Gain of what? 10. There's another gain of 10. And this 10, you have to use what? Must go to other income. Because this one, for investment property, all gains and losses must be reported in where? The profit or loss. So therefore, you go to your profit or loss and record fair value gain. So if there's a space here, you have to write other income. So it must go to other income. All right, fair value gain. Fair value gain. And then it's 10,000. Open your brackets. It's 390,000 less 380,000. And that'll give us 10,000. That is the gain or loss. Good. But let me go into the working somewhere again. I'll bring this final answer. It's 10,000. So workings number 3. That's workings number 3. Show that workings for me. So open balance of 380, closing balance of 390. So there's a gain again. Good. Oh, I'm not going to cap. Good. After we have duly passed the building from PPE to investment property in October, right from October to December. Now the building is investment property, and now we are using what? Fair value model. So any gain or loss that we are going to arrive at the end of December or at the end of the reporting period must be reported in the P&L. So there will be extra gain of what? 10,000. So, but that gain, we have to use what? Investment property rule, where fair value gains and losses are reported in what? P&L. Unlike the revaluation gain or loss, which sum goes to where? P&L, which sum goes to the OCI. Good. So that is it. Good. Great. So, in the financial position, what goes there? Summary. Let's summarize all what we have here. First, the asset value must be reflected in the financial position. So, first, we'll call it investment property. And here, because we don't depreciate investment property carried at what? Fair value, what do? We will we will carry it at the fair value. That will be the 300 and what? 90,000. No depreciation, no accumulated depreciation. They're not going to subtract any accumulated depreciation. We are done. Good. Then second, any items that enters the OCI must find its way in the financial position too through the changes in equity. So here too, we go to the equity section and then we record revaluation surplus. Revaluation surplus of what? 26,000. We are done. That is the end of this question. Now, this is the accounting treatment. This is the workings. Case closed. So if you don't want to do this, then put this one in explanation. Debit this, credit this, take this, subtract this, add this, you are done. But normally we like in this format or we like this version. But God to save you from what? Exposing yourself. Exactly. Instead of saying debiting, now you meant crediting. And then adding, probably some people have termed that anytime you add, meaning you are debiting. So don't expose yourself. Do this one fast. Let it be there. Here, no debit, no credit. Yes, so that is it. I'm done. Now your trial will be, in fact, there will be, I'll do one last explanation and I'll put a trial on the screen. You do it within 2 minutes. It must be done within 2 minutes. Trial. Good. Now, I promise that I will explain the treatment of investment property between group members. Yes, we will do group accounts. That's parents leasing out office building to a subsidiary. How do you account for this? I think we did that in the earlier video. Good. You've put in some few points down. So let me dust the ball. So you're talking about the group accounts. So parents leasing out building to what? Office building to the subsidiary. Then group. In the group account, what's the treatment? In the parent books, what's the treatment? In the subsidiary, what's the treatment? So first, the parents is the one that doing the transfer. So it becomes what? Investment property. So parent books, it is what? Investment property. That is IAS 40. Subsidiary, it is owner occupied, IAS 16. So we use IAS 16 to account for it. In the group account, it must be accounted for in what? Under the IAS 16. Good, PP. So that is it. So you may be called upon to explain. They've done it before. I'll look for that question and then they just need to do it. This is the few illustration that we have to look out for. How the property can be moving between related parties. Good. Now try this. In the group, it will be recorded as PP. Why? Because the parent and the sub, they are one. You cannot rent something to yourself. Abigail it. Cannot rent something to yourself because the parent and then the subsidiary, their account must be prepared as if they are what? A single economic unit. So if you are a single economic unit, you cannot rent equipment at the same time you are using it. So parent rents, service using it. Meanwhile, these two they are one, the two shall be what? One. Good. So you are renting service using it, or you are renting parent using it. So in group, it is still within a group. Unless parent lease it out to a third party, someone outside the group. Because in consolidation, that person's PPE will not be consolidated. It is PPE here, you've consolidated it. And in this investment property, you've consolidated it. No. It must be cancelled out and leave one as what? As PP. So that is it. Now try this. Only 2 minutes. So 2 minutes. Try this. Now let's try this. 2 minutes. You pause the recording. But don't forget that illustration 5, 6, are years and four. So 4, 5, and 6. That's upper primary. 4, 5, and 6. But we are doing question 7 now. Good. 2 minutes. So question 4, 5, and 6 are years. So upper primary questions are years. We are doing question 7. Good. It's very short, so 2 minutes to be able to finish. Kindly pause the video and then work it out for us. Now let's solve it together. So if you are looking for profit or loss, 2 items. Don't forget the steps in derecognition. When you dispose of item, what do? Still the same, the 3 steps. Step 1, add the proceeds to your cash. Step 2, calculate the profit or loss. Step 3, do the removal. It's also valid here if you saw some of the assets. Okay, now let's see. Here, the question requested for the profit or loss. All right, profit or loss. As it start now, you wouldn't know whether it will be profit or loss, except for the other book. Good. So first, using the cost model, that's the first approach. Whether cost model or fair value model, the format is still the same. If you want to calculate the profit or loss, what you have to do is, so first we need the proceeds, how much you sold the asset for. So proceeds. So let's go to the question and pick the proceeds. You are done. And then you find the carrying amount. That's the end of the game. So from the question, on January 2011, the property was disposed of for the net proceed of 8 million. So proceed is 8 million. So if here I'm reporting in millions, I just have to put 8 here. I'm done. So 8 million. Less what? Carrying amount of the assets. Cost model, the PPE. Cost model, the investment property must be depreciated. So you have to depreciate this investment property over the useful life of the assets. So first, ABC Limited purchased an investment property on January 2008 at the cost of 7 million. So that's January 2008, the cost of 7 million. The property was estimated to have a useful life of 50 years with a net residual value. Good. The company adopted fair value model for subsequent measurements. As at 31st December 2010, it was fair value at 3.8.4 million. Now, what will be the accumulated depreciation and what will be the number of years? So from January 1st, 2008 up to December 2010 or January 2011, still the same. Automatically, they are the same. So how many years? 3 years, right? So 2008, 2009, 2010, 11 will not be passed. So 3 years. Good. So all what you have to do is go to the long procedure. 7 million less the accumulated depreciation. Depreciation for a year will be 7 million divided by 50 years times 3 years. So this alone will give us what? Accumulated depreciation, and this is the cost. Then that will give us carrying amount of, but if you don't want trouble to, you can use the shortcut approach. If they spend 3 years out of what? The 50 years, then it will be 47 out of 50 times this 7 million. All of this will give us the same answer. This is what we get. If the figures are too small, we can also report in thousand. Okay. If I'm going to report in thousand, then let's do something like this: 1,000 here. Then here will be 8,000. So if you're going to report in thousands, that if the figures are too small, can get, and then it might take some detail of over 50 years times 3, and that'll give us 400 and 420,000. That's this one alone, right? Is that this one alone or like all of them together? The final answer. Okay, now let's see. So if you do the calculation well, the current amount will be 420. Let's confirm. So times 47 divided by 50. For it to be 6, yeah. This alone is 420. Then you take it from the 7,000 to get the carrying amount. So therefore, the carrying amount will be 6,580. So 6,580. So that's the carrying amount. So what's the profit or loss? And you are done. So therefore, to get a profit, 8,000 minus a carrying amount of. For this carrying amount, you can also use the shortcut, which is equal to this 7,000 times the number of years remaining, which is 47, all over the entire number of years. Shortcut approach to get the carrying amount straightforward without traveling through long process. We shall adopt several ways of getting these figures faster. But the exam question that we are going to solve, in fact, even understand that that's what we need is part of it. We like make it. By the time you realize you're looking for carrying amount, time is gone, so we can adopt these shortcuts. So let's 6580. That'll give us 1,420. 1,420. Good. So that is the profit. Now, if you're using the fair value model, to be very good and very straightforward. Fair value model, no depreciation. All what you need to do is to get the fair value of the asset at the date of disposal. So under the fair value model, still the formula does not change. So the proceeds. What is the proceeds? Still 8,000. Now the current amount over here is the same as the fair value at the date of disposal. Let's go and pick the fair value at the date of disposal. That's it was fair value 8.4 million, so that's 8,400. So therefore the current amount becomes 8,400, no depreciation. So therefore 400 million loss or 400,000 loss. So you'll be lost on disposal. Yeah, then how do you treat this profit or loss on disposal? Give me the accounting treatment and let's see. Good.